Yeah.
It's like once you stop.
I had a deal with.
Tyler,
so
mic check.
Before I came here, I was at New Western. And I tried doing a deal with Starter over there. He was just like helping me find a buyer because I had.
Check 1, 2.
And he found a buyer for like $30K over what we were gonna sell it at. So Starter would have made that $50K. And we would have made like $10K or something. But the buyer, like, when we James, this is Corinne.
So,
Hi, nice to meet you.
hello, nice to meet you. We can have an intimate class today.
Private, or I guess private's a better probably word to use.
Wow, cool. What's your name?
Tiffany.
Tiffany?
Yes.
Nice to meet you. Where are you guys from?
Nice to meet you as well. I'm from here. I live in Tacoma.
Okay, go on.
Yes. I was saying I seen you at Bigger Pockets, and so I started following you.
Oh, cool. Thank you.
And figured since it's local, might as well come out.
Yeah, have you bought anything in Tacoma or?
I mean, I've had a couple of houses, but I've mostly started investing out of state, and now kind of trying to bring it back home.
Oh,
Start
cool.
some investing here.
What kind of where'd you buy out of state?
And right now I'm in Philly, but I'm looking at some properties in Pittsburgh that I'm maybe transitioning over to. So mostly just Philly. Right
Okay.
now.
How's Philly?
It's great. It's good. It's a lot more affordable.
Yeah.
So you're able to get a lot. Actually, this deal I just sold a property there and made a profit, which was good. That was my first deal.
That's the goal.
Yeah, that was my first deal there. I bought it sight unseen and was able to make a profit. So.
Then Philly's awesome.
Yes, it is.
If you're making money, it's awesome. Where are you from?
I'm from Kirkland.
Okay.
Originally from Hawaii, but I live in Kirkland now.
Oh, nice. Have you started investing around here at all yet?
Yes, I've done a couple here, but mostly it's in Hawaii.
Oh, cool.
Yeah.
Nice. Over the water. Were you flipping or keeping them?
A little bit of both.
Yeah.
Price points are good compared to you.
What have you done locally?
I'm sorry.
What have you invested in locally?
So I've done one in Everett. It was last year.
Okay.
And then one in Kirkland. So I've only done two.
Cool. 2 different markets, 2 different types of houses.
Oh yeah.
I'm sure.
One really low end and one really high end. So it's kind of interesting.
Which was the high end? At what price point was it?
It was 1,235.
On the
Like
resale?
yeah.
What was it worth when you bought it?
So I bought it for $600.
Okay.
And then I think it was kind of a shit show.
The house was?
Everything, the whole entire transaction. So that was, it was a learning experience.
Who did you buy the deal from?
Myself. Well, it was a referral. So I tried to take it down myself with someone else.
Oh, it's a partner?
Yeah.
Partnerships can get messy sometimes.
Yeah, it's done. We don't have that partnership anymore. So it's like, it was done.
Partnerships in real estate or is it tough?
It was
Tough deal.
Yeah.
Luckily, me and Will have been partners for 18 years. We haven't had too many issues. So but then we've had other partners not so.
Mhm.
it didn't work out so well. But yeah, it's tough, especially when you're doing a house because there's so many things that come up.
Yes.
But we'll dive right into this, and because it's a smaller group, we can make this pretty like if you guys have questions, just go ahead and answer. Like we can make it more of like a chat than anything else. And then we'll kind of run through. The whole point of this presentation is really to talk about how we do business, how we underwrite deals, what our processes are, what our assistance is from there. And then we kind of just walk you through our fix and flip, buy and hold. We're going to talk about hard money for leverage. Who'd you finance your deal with up here?
It was with Rain City.
Okay, yeah, I know those guys real well. Yeah, we're better.
Much better.
Yeah, and then we'll just talk about kind of like how we do business, and then from here too, we have like a market update tomorrow. And so you're going to start getting emails. We do a lot of free education stuff. So like tomorrow, I'm summarizing all of 2023 Washington State and break it down King, Snohomish, and Pierce County.
Awesome.
And we're really this next 12 months, we're going to be doing a lot of that stuff where we're doing this class, but then we're going to be doing different types of investment training. Like, hey, this is what we're seeing opportunities are. And we're going to be doing a lot of live walkthroughs too. Like, hey, this is where we're at in the project. These are the problems we've had and going forward. So, yeah. Well, thanks for coming out. I know we canceled our class in December because it was icy.
Snowy.
I know. But people still showed up and we're like, oh no. But I went. So give you a quick background of who we are. This is my business partner, Will, and myself. So how our companies, we have a family of companies that operate out of this business or out of this office. They're all individually run. They're their own brands. They don't, like the lending company, a lot of times even our own clients outbid us on market with our own money. So they're all independently separated out companies. So depending after the presentation, be like, oh yeah, well I got my finance guy, or I want other financing terms, and you're writing up an offer on your own. You can use whatever service you're looking for. So quick background, Will, he handles a lot more of interest funding. He does our development, like our townhome sites, our apartment syndications. And then I run the brokerage and the off-market team and all of our fix and flip. So we kind of do a divide and conquer. We've been working together since 2005. We actually started our business the month subprime mortgages went away. So that's how I think we became so close. It was like, oh shit, we're in some trouble here. And we kind of just grinded it out. So what my background is we've been active investors since I was 22 years old. We've been buying and selling properties. We started out flipping homes, then we started keeping rentals, doing our BRRRRs, getting more single families, and then growing our portfolio from in 2000, after I had to restart, from 2008 to 2011, we went from like 11 homes that we acquired as BRRRRs, and we traded them out for over $1,000 since then.
Wow.
So we 1031 exchange a lot. We're constantly trading. We're always buying value add just to increase the value. And with your experiences, out of state or heavy rehabs, if it was in Kirkland at 600 something, I'm guessing you put a lot of money into it.
Yeah.
All these experiences help you define you as an investor. It just sharpens your blades, right? So even if the deal kind of went a little sideways, you probably learned a ton, and then you can kind of perfect that system. And as soon as you perfect the systems, you can do whatever you want in this market. I know Andy's been perfecting his system. He's a client of ours. He came back to the class. How many projects have you done with us?
I don't know. I hop on these things every time. Oh, projects with you. I don't know.
14,
Yeah, 15, something like
Yeah.
16.
Yeah.
That property's in my slide.
in the last couple of years.
Yeah.
Right. It's in
Is
there.
it, and he
We're
worked
coming at the end, yeah.
a little tip to is Andy actually was working with a competitive company, and we just gave him a way better experience.
I mean, it's true. Everything in state is with these guys.
Yeah.
Out of state is a different.
And so also on my background, I'm just the broker. We handle all the underwriting. So since founding the company, we've done over, sorry, it's a little bit outdated. So we've done over $1 billion in transactions with investors. So that is all our shop is set up for, is selling fix and flip development, BRRRR opportunities, discounted real estate. We don't really show properties to people. We're securing investments, putting the package on them, underwriting them the way that we're going to go over, and then our investors can look at that project. So it's not your traditional showing brokerage at that point. We're not going to go out and show you house unless it's like a single family or it's like a rental property that we're specifically looking for. Then we'll go out and look more. But typically, we're just going to give you the numbers. So since founding, we started our off-market business in 2007. It was called Invest Now. And then we founded our brokerage. And the reason we founded our brokerage is because the market was so hard to invest in because it was constantly declining. There was massive inventory. And so the whole reason we even started the brokerage was to help our clients mitigate risk because we were active investors buying and selling stuff. And people were just nervous to get into the market. So inside of our brokerage, we help mitigate risk by helping them with the construction, giving them referrals, design, and giving them our template for success. And that was the whole reason we did that, was just like, hey, we'll be your brokers and we're going to help you all the way around. And it's done good business since doing that. It kind of took off. So since 2010, we've done over 3,500 transactions with investors. We've done $1 billion in sales, and then we've helped investors design and list over 1,500 homes. So we have a heavy background in this specific market. So what our brokers does is we source properties on and off market. We don't care where it comes from. It's all the math. We have an off-market company called Buck Buys Houses that's constantly working with sellers off-market. And then our brokers, who are a lot of them in the office, they're constantly going through the MLS, firing out offers, seeing if we can secure that investment. And then from there, once we secure it, then we do all the analysis on it. So we're going to run the comps, the cash flow potential, the profit performance, and we're going to break it all down for you, how I would do the project or how we feel comfortable with it. And then it's up to you at that point to where you can change things around and we'll adjust the analysis for you. And then the execution. Once you buy a property, it's a lot different than most brokerages. Most brokerages are going to find you that deal, and then they're either going to list it for you later and say, hey, let me know when it's ready, or they just sold you a deal and they're out, right? And their hands are free of it, which is, as a business owner, it's not a bad business. You sell the property, you're off. For us, we then kick in and we'll go over these services. Is we're going to be with you all the way through the stabilization and then help you get it sold. So we look at all of our deals as a partnership because we're with you for 5 to 9, 12 months. I mean, you've had some projects go a year or more. So it's a long haul with our clients. And so we just want to make sure that we're getting it. Also make sure that we're getting you good buys, because we don't want to deal with something for 12 to 18 months and then for it to be a bad buy. So our services, so we offer acquisition and purchasing. We're going to do underwriting on every property that we ever send you. We're never just going to send you a property and say, hey, look, you can buy it for 400 and there's a comp for 700. We're going to break down the math behind it. We're going to give you contractor referrals. We'd like to say buyer beware though. These are guys that we know, our clients know, but they're independent companies. So we have no control on how they operate their businesses. Reason I say that is because I've had a lot of contractors burn me over the past. These are guys I've known for a long time. And so you just never know when that could happen. So we highly do suggest that you have your own teams, and then we can plug people in for you. Works really well. Like if your roof came in high, we're going to give you 3 roofers to call and help you get the numbers down. And then we're going to get you, oops, I'm going the wrong way. We're going to get you financing referrals, which will interest fund you for the takeout financing. And then we have a group of different mortgage officers, commercial bankers that we're going to say, hey, based on this deal, you should call these 3. And so we work with tons of different financing companies just to make sure you're getting the best possible rate. Any referral we get paid $0 on. It is all because we know they do good business and they're getting you the best price, or we just know they can get your loan done at that point. And then also the design services are all included with the listing. That is nothing, it's not extra. So before we kind of jump in, I always say that you need to build your bench before you get in this business. The reason I say that is because I lost a ton of money in 2007 because I had no bench. I went from flipping condos to flipping a massive fixer. And I did it on time and materials, and it was just whatever the guy said was what it was going to be. And I went double the budget, double the time frame, and then the market crashed on me. I lost all my money. And so if you have that bench, you can get in and out. Time will kill a deal. And so what we always tell investors they should be building as they're looking at investing or getting going is try to find 2 reliable contractors, just people that you trust that can look at a project. Sometimes those contractors aren't going to do the whole scope of work for you, and will help plug people in like painters, roofers, cabinet people, but 2 people that you can depend on. If you're a newer investor, I highly recommend use a general contractor, not sub it out yourself. Subbing out yourself can get complex, things happen and get stalled out that way. I tell people they should have 2 reliable subcontractors for every trade. So electrician, plumbers, HVACs. because you never know. Like I have a bunch of electricians I've used over the years. If they're busy and I call them out, they're going to give me a really high price, even though I know them and I know what they usually work for because they're busy. So having that bench makes it to where you can interchange out people. You need a hard money lender. The deals that you guys are chasing are discounted real estate. Most of the times people do not want to finance those deals, banks, especially right now. So to get those big discounts, you got to come in with cash. And that's how we can get those big discounted margins. You want a conventional lender and a commercial lender, or at least a couple of each. And we're going to get you guys out referrals on all this stuff as well. The next thing you guys want to do is make sure after this meeting, if you want to kind of move forward or start to move forward, you want to get pre-qualified. Get pre-qualified with a hard money lender, but also permanent finance lender. The reason I say that is you always want to know what your exit strategy is. If you're buying a deal that you can only flip, you can't get that back loan, then you might want to be a little bit more careful with that deal. You know, if it's a deal, you know, I call them the safe flips in today's market. If you can buy it, rehab it, put it up for sale, it doesn't quite sell, but you can refinance and then keep it for a year or two and then sell it later. A lot of times those deals will work out anyways, but you need to make sure that you can actually get that financing or it's kind of a moot point. The other reason you want to be qualified with a hard money lender is if a really good deal crosses your plate, that means it's not going to last long, even in today's market. I mean, we even see it. Homes get listed low on market. They get bid way up and they close quick. So a good deal still gets traded quickly. And so you need to be approved, ready to go with a hard money lender. And nothing's worse than not being like, I just missed a good deal in Bellevue. It was like one, no one wanted it. It was on market forever. And I remember I was at 1.3, but I wasn't ready in a different way. My contractors were so busy and the market was slowing down. I didn't want to have this project sitting there for a month or two. And so I didn't do it. And then all of a sudden they freed up and I had the guys, but it was like 3 weeks too late. And if I would have bought that property, I could have got it for 1.3. It was worth 2.7 all day long. The 2.7 comp was my house around the corner. And so I felt really good about it. And there was big margin in it. But I wasn't quite ready. Or if I would have found a third contractor during this time that was kind of low, I could have actually pulled the trigger. So I lost a lot of money because I wasn't ready. So our goal, once you get your kind of benches set up and you guys, after this meeting, you're going to get a survey. We want to bring you in for a one-on-one, find out your goals. That's where we can get you out referrals or talk to you about what you guys need. And then we'll kind of walk you through that process. But after we get through pre-qual, then it goes into how do we look at the deals? How do we find these deals? And then what is it going to look like when it comes to you? So our brokerage is broken off into teams. So this is our fix and flip team. We have 4 brokers that work specific territories. And the reason they work territories is because they know that market best. Instead of working with just the client, they know the area. They like John Whitney has worked in South King County in the East Side with me for 12 years. He knows every street. We've driven them all. He knows what the neighbors are. He knows what sells, what doesn't sell. And so they really want to be specialists for what we're looking at. It's broken up in South King County, Seattle, East Side, Snohomish, and Pierce County. And so depending on where you want to look and what your liquidity is, we're going to pair you with maybe 1 or 2 brokers because you might be able to buy a deal in Pierce County or Everett, depending on what you're looking at in the price point. And then from there, we have a listing team. We have 4 listing brokers. They get assigned to you at closing. These are the gals that are going to come in, help you with the design, help you with the referrals, help you with the cabinet layouts. Every one of these brokers has personally worked on my own houses. And they, like Megan, for example, she runs my projects. She's looking at the space. I know Andy works with her all the time. She's getting me the design. I'm giving her my budget and allowances. She has to go source the stuff for me because I don't have time to do that anymore. And I can honestly say, we used to go off of templates for years. And once we gave the gals more feel free reign on these, our homes got so much better. And they gave so much more kind of character in them. And then from our listing team, then we have our support staff where we have 2 full-time transaction coordinators and an assistant. So at any time, you guys are going to be covered with what you need or if we need to get things done. And then the specialty thing that we offer our clients, and this is all included in our listing fees, is we have a client service manager, Ryan. So Ryan has been a project manager of mine for 12 years. He now is in this role. He's been in it for 2 to 3 years, and he's constantly meeting with new contractors, getting estimates. If you buy a house and you open up the wall and the contractor's like, it's 20 grand to fix this. You call your listing broker, you call Ryan, they're going to meet you on site. They're going to look at it and go, no, it's not going to cost this much or it shouldn't cost this much. Call this person instead. because a lot of the cost on renos are done on the change orders, right? Like if you started your Kirkland project, you probably had an initial budget. If it went sideways, I'm guessing change orders got out of control.
Yeah, that's
It-
where there's all kinds of stuff.
Yeah, and the change orders will crush you, and because the contractor's already got the job, so he can kind of charge what he wants at that point.
Yeah.
But if you have that extra resource, that's why he comes in and helps you sub that out. And so, so he's there to kind of be the extra pair of eyes on you. He has a lot of experience. He's run tons of my projects, and that's what we tell our clients is the advantage of our brokerage compared to anybody else. We are providing you with not just finding new deal flow, we're providing you with the tools to help you be successful and the team to back it up with it. So it's just a lot different experience than any other brokerage offers. I can tell you the reason no other brokerage offers this, because it's a giant pain. Like all these services come with a lot of headaches and it's a lot of work, but we know it does well for our clients. So acquisition. So how do we work versus a typical brokerage? So most brokers are going to go out and show you properties, going to write offers. You might get it, you might not get it, and then you move on to the next. Ours are all actual opportunities. We write contracts because we know time is a killer on numbers that we know make sense. We put up the earnest money, we secure the deal. If a client doesn't want the deal, I buy that property. And so we know our numbers are good. The reason we do it that way is A, we don't have time. And sometimes a client's opinion might be different than ours at that point, and we know it's a good investment out there, and we know it's too competitive anyways, and we got to kind of lock that deal down. So you're always going to have an actual opportunity. We'll go over that in a second. The pricing's fixed. It doesn't go up. It doesn't go down. The only time it has ever gone up is when a client has taken a deal, and the client right behind them that wanted it so bad, they paid our client to walk away, but we won't take any more money on it. And so the pricing's all fixed. We feel very comfortable with it. And then during that, in our acquisition too, we're always going to give you an analysis overview. That's going to be walkthrough notes, deal performance, an exit strategy, a rehab plan, an estimated budget, and how we came up with it with the math that backs it up. And then we're always going to give you a CMA and comparables to break down how we came up with that value. Or if it's a rental property, we're going to give you rent comps. Our listing service, like we talked about, is designed to budget train. These gals, they know what they're doing. They're going to be able to look at your layouts and say this one doesn't quite work, or let's switch the layouts to keep your costs down. They have learned that because I'm cheap. And I'm always like, nope, I'm not spending that on my property. And so that's why they work on mine first. So they're really going to be able to help you through that process. They're going to give you up-to-date market updates. So as soon as you buy that property, they're going to put you on auto comparables where you're getting comparables of whatever's going on that's similar in your market. So you know whether you should spend more or spend less. And if something comes up, they're going to talk to you about it and say, hey, maybe we should scale it back. And then we do a once-a-week meeting with myself and the whole team. And we're looking at comps and going, okay, hey, let's switch this plan up. So we're always watching that investment for you. And then they can do monthly or weekly job site walks for you anytime during the construction process. So you call them, they'll walk it with you. They'll give you their opinion. You have the client service manager, and then they're always going to be able to give you a CMA to back up values as you need it, like throughout the project. So now that we kind of went over the services, let's just talk about how does our process work and like what it actually looks like. So typically you're going to come in, you're going to do your one-on-one, we're going to narrow your buy box. And then the brokers are we're going to see deal flow, but they might not work for you. And we're not going to call you on deals that don't make sense. We're never going to try to talk you into doing more work. We want you to be comfortable in this investment. That's a really big deal to us because a drowning client is not a good experience. So we're going to really narrow your buybacks and narrow your skill set, and then we're going to send you deals. If you want to see everything, just tell me you want to see everything, and we'll send you off every property. But then you're going to get a property just like this that's delivered to you. It's either going to be an Outlook form or in this fancy way. Every time on the email, you're going to have a blurb about what the property is, where the location is. If you don't quite know the neighborhood, we're going to give you a summary. Then we're going to break in the core numbers for you. So on this property, it's in North Tacoma. Once you go, I'm very interested in this, they'll send you out the address. We don't send out the addresses until someone's like, yes, I want to look at it. You know what the price is? That's $410,000. That includes all fees except for your closing costs, because some of our clients pay cash and some get a loan. That's going to change your title insurance policy. So that's all fees but your closing. Then we're going to put in what the estimated fix-up was, the value, and then estimated profit. This is going to give you a bullet point of what needs to happen on the property, but this is all the summary of the property. The links are what are going to break down how we came up with these numbers. So then as you go through this, you're like, yeah, I'm interested in this. Let me keep going forward. Then you can click on the photos. We will always put in 50 to 100 photos. The worse the property is, the more photos we're going to give you. Because our job and our goal is to make sure we're not wasting your time. We don't want you to get in your car, drive down to Tacoma just for you to get there and be like, whoa, no thanks. So we're going to try to spook you with these photos. This house wasn't so spooky though. It wasn't so bad. It was just an old house, needed mechanicals, but it was like grandma's house. Dated, but it needed wiring, plumbing, a full update, but it wasn't really gross.
That's not bad.
No, it's not bad at all.
It's
I haven't bought a property this clean in a long time. And typically you guys are on market deals or cleaner, or off market deals are a little bit. And they're usually it's like you still got to do the same things. The one difference is you got to take $10,000 in garbage out of the off market. But you're still doing the same stuff.
Yeah.
And so as you can kind of go through, then you can go through the photos and be like, hey, I've done a project like this, or I like this house. And then once you're done through the photos, you're going, okay, let me look at this more. So then you can click the next link, which is going to be our financial pro forma for the project. Okay. We're going to lay it out 3 different ways for you. And we're working on a couple new pro formas for our clients so they can have them and use them a lot easier. And those will be wrapped up actually next week, and they'll be going on our website for people to use. But this tells you the acquisition price at $410. We had $130,000 in fix up. We had a $700,000 value, and then we had an estimated hold time at 9 months because we knew this property needed full permits, and usually it's like 2 to 3 months to get permits in Tacoma down there. And so we factor for that. The reason that's a big deal is because you have to pay debt during that time. And then what this is going to do is it's going to break down 3 different scenarios. One is cash. If you just are sitting flush and you want to buy this property, you pay $410 for it, put $130 in. Your total project cost is $540. We add in $2,500 for like miscellaneous expenses throughout it. And then your direct cost is $543, $699 minus your real estate commissions, your excise tax, your title, and your escrow fees. Here's your net profit of $100,000, which would have been an 18.5% return. And that was a pretty good return for what North Tacoma was offering. Then these are 2 loans that have been already approved with interest funding. So there's interest funding, they'll talk about it in a second, is they offer 2 products. One is you can just put a minimum of 20% down, maybe 15% depending on the purchase price, up until as much as you want. That's really for borrowers, and I would say most people don't use that loan because with investors, they're trying to leverage, use construction finance and get the highest return. Some people have a lot of cash and they're like, well, I'm not making any interest on this anyways, and so they'll opt to just put more money down. So we always set this up with that scenario where you're just putting 20% down. It's going to factor in your down payment, your points, your interest payments, your direct costs, $699. Now your value, your profit went from $100,000 down to $58,000, but your cash on cash return went from 18 to 23%. So the theory of leverage is you know if you're sitting on, let's say, $550,000, you can do 2 of these deals at 23% rather than just doing one deal at 18.5. So it's that time value of money, and so that's why investors do leverage. If you're sitting on, the only time I wouldn't lever is if I was sitting like right now, we just paid off a bunch of projects. And so I went and paid off 2 hard money loans that we have because we're looking for deals, and then I'll refinance those later once I find the deals, but I can kill my leverage costs at that point. What most of our clients do is our construction product, which is going to be, this is 25, it's usually 15 to 20% down depending on the deal. And that's where they're going to finance you. So let's say it's 20% down. 80% of the total project costs. So that's your purchase price and your fix up. And then interest funding is going to draw you back the construction loan. Okay. So all your rehab is going to be financed back to you. The big difference between interest funding and like Rain City, for example, is the day of closing, we advance your construction draw day 1. Because Rain City doesn't do that. Right. And so sometimes these hard money lenders most don't, but they're also usually like 10% down. And so that's just a marketing gimmick. Because if we're 15% down, but we're advancing you the construction cost for day 1, you're actually out of pocket the same amount and keeps you moving forward. Because if you put 10% down and then you got to come up with your first 25%, it ends up being about the same amount. And so the day of funding, you would get a check for like $35,000 back just to get going right away. And then they have a very simple construction draw process. Interest funding also does all their own internal draws. They don't hire a third party, which I know those third parties can be problematic because it's not someone from the hard money company. It's just some guy coming out to look at a project. And a lot of our projects, because we're flippers, sometimes a little disorganized, and the inspectors don't like it. But then, so this is going to break down all your numbers, 410. So on this project, if they were coming up with 25% down, it'd be 410 plus the 130. They're going to come up with 135 down, but their loan basis will be for 405. That's going to cover 9 months of payments, the points, the interest, the utilities, and then but then that's going to finance them back 130,000. So they're basically putting 135,000 down to get $130,000 back in construction. So if you really look at this deal, it's 100% financing. It's like getting a loan for the full amount and then coming out of pocket with the rehab. And so those are things to think about. And so because this is all rolled in, after all costs, your profit then goes from 58,000 to 49,000, but your return goes up 5 points because you're borrowing less, or you're putting less money into the deal. Your cash out of pocket on this scenario is going to be 250, and your cash out of pocket on this is 175. So construction allows you to maximize your cash. The velocity of money is how people make money in real estate. I have so much money, I got to grow as fast as possible. So the higher the returns, the more I can work it, the faster you're going to grow that pot. Do you guys have any questions on the pro forma?
No.
Okay. So once you go through the photos, you go through the pro forma, you're like, I really like this deal. It's hitting my returns that I'm looking for. Then we're going to say, hey, then we're going to provide you with the construction plan that we came up with. So we have 12 different design books for different styles. And we're actually ramping this up right now to where we're going to have like 40 or 50 spec sheets. And we're going to be able to send you spec sheets of, hey, this is what we think the property should be designed to have. It's going to have paint colors. It's going to have a theme all the way through. So depending on what the style of the home is. So it's going to call out shelving, appliances, all different faucets, where you can get them from. And so it really helps you control that cost. Not only that, we know that the trends work because we've sold so many homes. And so based on the architectural style of the house, that's how we're going to pair it up. Then from there, we offer different spec sheets based on the level of finish. If you're selling a $400,000 house, that's going to be a different faucet than a $1.3 million house. And so based on your price point, we're going to adjust that out. Or you can be like Andy and just go to the max every time.
Amazon, baby.
Amazon is key. And then, so once you go through design, you're like, I like the design, I like the flavor of this. And again, you guys can design the house whatever which way. We're just giving you a template. Then we're going to give you our construction breakdown. How did we come up with that 130? That is what most companies don't show you, right? They're going to say, hey, you need to put $100,000 in this, but they don't break it down. So we're at least going to break it down with how we came up with it. And then investors can kind of modify it, which way they have. So on our budget sheet, we're going to give you a rough calculation of the cost. We're going to, our budgets are based off historical rates and Brian calling through the subs and finding out per square footage on what they're charging at the time. This has been harder the last 12 months with the cost of labor. It just has, right? It's skyrocketed. That's actually coming down right now, but our pricing's staying high. And so until we can verify, we're just leaving our budgets alone. Labor's gotten really, really expensive. And then we break it down by allowances and install rates. And then we always say investors should verify all their own costs and adjust your pro forma accordingly. My costs are different than Andy's costs. Andy's costs are different than my costs. Some of our Pierce County investors, like we'll throw a budget of $100,000 at it. They're like, I'll get this number 65. And it becomes a great deal for them because they swing the hammer themselves. So always verify your costs. But this is how it's broken down. So for example, like electrical, electricians have quoted us that we refer out that they will charge roughly $3 a square foot to just run wire throughout the property. So we know we have a 2,000 square foot house, so we can say, hey, just the wiring is going to be about $6,000 based on our calculation. That's before tax. Then if we had a panel we'd install, that'd be $2,000. Then we go trim out. We got $2,000, and it'll be now this is actually up to $1.50 a square foot based on pricing, but it gives you the trim out number. So this is our rough end. Here's our trim out for it. We know we need 14 light fixtures at $45 a piece. That includes a $20 allowance. So you want to buy your light fixtures inside 20. We know our electricians install them for 25. So we can really break down our budget this way. And it is also a negotiating tool. Most people that get overcharged on construction is because they play that cat and mouse game, the contractor. Hey, my budget's $100,000. They're like, well, it's 175. And then they just try to meet in the middle. Whereas like when my electrician overquotes things, I'm saying, hey, dude, can you just come in? Can we go through these numbers? And then I go through all my install rates. And and he agrees to all the rates. And I'm like, so how did you come up with your number? And once they have to explain their number with logic, they'll come down a lot of times. That or they're gonna be like, I'm just so busy, this is my price, and then I gotta call someone else. And so it gives you a template to logically negotiate. Like, hey, electrician, you charge me $25 to put in each fixture, right? Yes. Okay. You charge me $2,000 for the panel, right? Yes. You said it would be about $3 a foot to run my wire, right? And then we go through it all, and then I'm like, well, where am I off here? And then maybe they have something else that I didn't notice, right? Or something like that. And it becomes a much easier logical negotiation. And then also when you guys are showing your construction team, you can kind of show how we came up with the budget, and they can go up there. After you go through the budget sheet, you said that looks feasible. Then we're going to break down how do we come up with that value. So we had a value of $699 on it. We had one that was a little bit more dated at $669, and then we had a renovated one that was all redone for $702. So we came up with a $699 value. You're always going to get a link to these photos. You can click through all the photos. You can see what they look like. You can drive them. You'll have all the address. Then once the client was done, it ended up looking like this. So this was all designed by Megan, actually. So she picked the paint color. These clients are really hands-off. And she picked everything. Siding, windows, color. Or no, windows were already in. But it looks a lot better now, right? They put in all the flooring, the cabinets, the appliances.
Looks good.
Yeah, it turned out very sharp.
Yeah.
These guys are good. They do a really good job. Basement was all finished. And then most importantly, what happened on this deal. So this was a deal that we blasted out to our whole clients. One of our clients that actually lives in Ecuador half the time bought it, and she had a crew up here. So Megan really manages these people with specs. They paid $410 for it. They actually put a little bit less than $130 into it. We had a target value of $699. We ended up selling it for $800,000. Right, this is right before the market stalled out. So if it was today's market, we probably would have sold for $660. But it's the way it went. $800. Their net profit ended up being $71,000. It was a 45% cash on cash return. And so other deals that we've done, and you guys, the reason we like to put these up, it just shows you kind of the margins that we're chasing. Here's one that the client paid $585. They put $85 in. It was a pretty cosmetic deal. As you can see, they didn't mess with a lot of the exterior, right? It was just kind of a slap back together. They sold for $850. Mukilteo. Is that yours? There we go. A $380. You put up.
For $380.
You know what? This thing was hammered though. There's a reason it was $380.
Yeah. Those are the best ones though.
The floor was sinking in the middle.
That's normal.
Yeah.
Sold for $650. And then these ones we like to show because these are a little bit bigger projects. So you guys, the ones with the best margin are usually your old 1920s homes in Seattle. They do come with a hair of problems with them. And so if you have the right construction partner, it works out. But the more risk, the better the profits. They paid $850, put $250 in and sold it for $1,433. And then we had, this was an Everett rental that was more hammered than your Mukilteo one. She took about $30,000 in garbage out of the yard. Paid $200. It was only 900 square feet. She spent $130 and sold it for $550. It was a great deal. All right, so we just covered fix and flips, and now we're going to kind of dive into the buy and hold strategy that we go off of. So things that we source. So we only sell rental properties that we do ourselves because we know how to analyze them. We've done them. Everything that we sell out of this office, if me and Will haven't done it, we don't sell it because we can't give the right advice on it. So things that we do sell: single family homes, burr style properties, traditional rentals, 1031 exchanging. Multifamily. We own a lot of multifamily. We have a Jen, who we're going to talk about, runs our multifamily department. We have a very vast experience in rooming houses. We have a 50-unit rooming house in Capitol Hill. We have 6 others right by University of Washington. They do work out well. Not so well during COVID though. Rooming houses, not good for COVID. But now they're back to normal. We do commercial vacation rentals. We have a background in that. And then we do syndications for people that want to be more passive. You do need to be accredited though to invest with us. So that's a minimum net worth of $1 million. That's just the regulation. And then typically the average size of those deals, we're doing about we're closing on one in about 3 weeks. It's 54 units. So typically they're 30 to 60 units in that range. If you are accredited and you want to talk more about it, we'll do a call together. So why holdings? So there's many reasons why you should keep them, why you should flip and keep them, right? We built our rental portfolio by flipping houses, saving our money, reinvesting it. If I could have turned back the hands of time, I would have kept at least half of those because we were buying homes for $75,000 back in the day. Now I can't, but luckily we did keep a lot of properties, but there's lots of benefits to keeping the properties. A is the first thing. If you keep that property for longer than a year and a day, you don't get short-term capital gains, right? So you are already making 10 to 15% more on that deal just by keeping it for a year. You can, on rental properties, you can depreciate them. If you have multifamily, you can cost segregate them. A lot of our clients buy properties just to get the tax write-off to drive down their income. So there's lots of benefits to them. It's a hedge against inflation, right? Real estate, everyone's always going to need housing. Even in the 2008 crash, now we've seen this massive spike in rents, but the affordable stuff has all pretty much stayed steady. We're still getting higher rents than our performance today with it slowing down. In 2008, when it crashed, rents didn't move much at all. It took a little while for us to rent them, but we were still renting this stuff for the same pricing. It gives you passive income, and the goal is, right, to not work. Fixing and flipping properties is a lot of work. Developing is a lot of work. Collecting rent, not so much if they're stabilized. And so that's the goal, right? But you got to build that nest egg to get enough in the properties that will pay you that comfortable passive income. And we can sit down and talk to you about all that. Other things that we have specialties in, 1031 exchanging. We have done a ton of 1031 exchange. We just did one in West Seattle. We like to trade our doors out, see what we own. Can we increase the cash flow, increase the position? I personally sell off my rentals every 2 years or so because they get this massive equity play. I can take that gain, sell it, and go buy another fixture, rack up the equity gain again, and then keep trading it out. So like right now, I bought a duplex, huge fixture no one wanted. It was on a hillside falling down the hill. I have about $250,000 in equity. It cash flows $1,500 a month with no money in. It's a great deal. It's a lot of work. I had to rent it for 18 months. It was like falling down. It's up for, even with those numbers, no money in, that much cash flow, I can trade that for, I can take those 2 and trade it for 6, right? So it's up for sale. And if it sells, Jen's going to find me a property. We're going to trade it out because I'd rather own more doors and buy it as a fixer, increase the value again. And all of a sudden I'm going to increase that equity. That's how you grow wealth. Don't be complacent with the properties that you own. See if you can trade out for better. Self-directed IRAs and 401k purchasing. If you have that or you have a retirement account, we know how to set you up with that. You can use your 401k to flip properties. You can use it to buy rental properties. Opportunity zones, if you have any interest in that. In addition to, we have a big off-market company. If you're looking for something specific, we have a bunch of properties we know what the sellers will sell for and locations. And so if you're looking for something specific, we can be like, hey, this one could work for you. So we have a lot of additional opportunities that aren't around anywhere else. With a massive background in leverage and structure, that is the key to buying a property or buying rentals. If you go buy 20% down, you run out of money eventually. Whereas if you set the leverage up right, you can get most of your cash back. You keep that gunpowder on the sidelines. You can go buy another deal, get more doors. And then also our property management company, we actually, for years, I avoided running one, but our clients kept asking us. And so we have a property management company that actually does it for a killer rate. It's at 7%. That's a lot lower than the standard. We're working on that number right now because inflation has been crushing us on our labor costs, but it's about 2 to 3 points cheaper than normal. And then, so those are the additional services. The team is ran, and we're hiring actually another broker right now as well to kind of find more off-market deals. So it's ran by me, myself, and Jennifer Hafner in the back there. Jennifer came to us because she wanted to buy properties, and then she liked it so much she started working for us. So she is awesome, you guys. The buy and hold's different than the fix and flip because we hold your hand. It is important that we're finding you the right property that you want to own for a few years. And so she's going to be doing a little bit more hand holding during these, whereas the fix and flip, like, here's the numbers, it makes money. Does this work in your system? So Jen will kind of walk you through that. We have interest funding for your BRRRR style construction financing. That's key, right? Getting that construction loan. A lot of these properties that we're buying as BRRRRs they won't get a loan traditionally because they just need too much work. So interest funding will get you set up with a takedown loan. And then we have Jason Zhang and 3 other mortgage brokers that we would refer you out to see who you like best and what their rates are. And we get you pre-qualified before we even start shopping because we want to know what your financial position is. And then our 1031 exchange partner is Kyle Williams at Investment Property Exchange Services. It's Fidelity National Title. The reason we refer people there is we know they're in good hands. It's just a big company. And they give us a good deal for our clients. So building long-term wealth. Why do you want to keep them? Well, rents in 2022 King County was up 20% on rents. So if you bought a property in 2021, you were going to crush your cash flow. Pierce was up 22%, and this is wrong. Sorry, guys. This is 21% in Snohomish County. There's that typo again. And then one thing we'd like to point out is the average home appreciation for the last 20 years is 3.53%. The reason we do that is any deal you look at, we're going to forecast out 3 years, 5 years, and 10 years. So you can see what the appreciation play is, what the cash flow is, and then summarize it for you. So what is our process? So we have two different processes for depending on what you're doing. If it's an acquisition, you want to buy and hold, we want to get you in for a one-on-one meeting. We want to find out your financial position. We want to find out what kind of cash flow you want. Do you want better neighborhoods? Do you want cheaper ones because you can get better leverage on them? And so we want to narrow your buy box. Then if you own any properties, we will look at those for you and go, hey, look, if you have this much, and we'll run a return on equity for you. Like, is this something good to keep or should you be trading this out? Because that's the key metrics on that. It's not just your cash flow, how much money you have in, how much cash equity do you have there, running the total cash flow on that. And if it's below 5%, if you trade that property out, you can double your cash flow most of the time. And if we don't think you should sell, we'll say, hey, just leave it alone. I would keep this one. Or if there's like additional, like if it has a development upside, we'll say, hey, leave that one alone. Like those extra little kickers on the deal. We're going to put together a 5-year and 10-year action plan for you to try to get you to that passive goal. We're going to get you pre-qualified, and then we're going to start looking at opportunities. If you have something that you want to start trading out, we're going to do a one-on-one meeting with you. We're going to look at all your portfolio. We're going to run comps for you. We're going to show you what your net proceeds were, where your cash, your return is right now, and then what it will look like if we trade you out. And we have a really cool calculator you can load your properties in and trade around and see what the position will be. And so our goal, we will not have you guys do this unless we know we can get you a better return. If not, leave it alone. So, and then if anyone, does anyone not own their own primary residence? Okay. So we have a house hacking program too for investors or people that come in here that don't have a primary, because you can buy a rental with 3% down. So we call it the house hacking or program. It's basically we're utilizing a zero down home buying program, but you can classify it as an investment. So and that's actually ran by Liam right here.
My hair's so short.
I know, that's back when you were so hipster. How we got Liam came into our class to learn, and then he liked it so much he took a job here. So
Careful, you might get a job here.
So what is our approach? There's two approaches that we sell rental properties with. There's the traditional and there's the value add approach. Traditional is for investors that want to place money. They want to get a good rental. They don't want to do all the heavy fix up. They want to get a discount, but then just really collect cash flow. Typically on this, and a lot of our clients do that. A lot of them are like tech clients a lot of times. They're trading their stock money for housing, or just people that like a 1031, they're moving it over. So how we look at this, we're always going to break down the existing metrics. We're going to look at the pro forma metrics. Our rent's low. Can we increase them at that point? And then typically with this approach, you're going to leave 10 to 20% in a 2 to 4 unit. Depending on what kind of little discount. Typically, we're not going to be able to get that same discount because the property is so much cleaner. And so that's why we say you got to leave 10 to 20% in those deals. On 5 unit above, you can leave 20 to 40% in the deal. The reason we say 40 is if you want something in Bellevue, multifamily, the cash flow is terrible. It's all equity play. You have to put more money down because it won't cover. So most East Side investors are rich people that buy and they're putting 50% down. I don't own any rental properties in the East Side for a reason. I like the leverage. Value add approach. And then this is going to be where you guys can create those massive equity positions to leave little money in the deal, a BRRRR property. The BRRRR works on 2 to as many units as you want. And then how we're going to look at this is we're going to give you the pro forma metrics. What can you buy it for? What's the fix up value? We're going to run your leverage position because in these BRRRR properties, our target goal is to be below 75% loan to value. Whatever you're above 75% is what you have to leave in the deal. And so we're targeting those heavy value add, heavy construction plans. You can buy it, sit on it, renovate it for 6 months, then refi it, get all your cash back out. It's always going to be a 2-step loan process. Intrust funding is going to come in, set you up for your construction loan. We're going to have you pre-qualified, ready to get refied out. Once that property is stabilized, they will put you in permanent debt because you want out of the hard money as fast as possible. And then the benefit is you don't have to leave this 10 to 20% in the deals many times because you're increasing the value. You get to maximize that, so you get to refi it back out. The negative thing is you don't get rent payments for 6 to 9 months. That's the one thing they don't talk about with BRRRRs. When you're rehabbing it, you make no money. Yeah, and for a while, me and Will were in this massive BRRRR thing where we're just like fixing properties and trading them out. I don't think we got rent income on our whole portfolio for like 2 years. It was just but now it works really well. It was just short-term pain, right? Like we're just kept trading. And so, that's the downside. So depending on what you got going on, you don't make any money till really the end of year one on a BRRRR. But then you get that huge equity pop that ends it. If you want to invest it with us syndication wise, you got to be accredited. It's all passive income. You get a pref return anywhere between 6 and 7%. Our typical IRR on a deal on a 5-year basis is going to be about 15 to 17% on IRR, and then you get the bonus depreciation. And you don't have to do any of the work. We do all the work. We're going to find the building. We're going to stabilize it. We're going to rent it. You get your cash flow check. The negative on that for newer investors is if you're trying to grow your portfolio, it's harder to grow. It's better for passive if you're just trying to place money. So let's talk about a recent deal that we just did. It was a 2-bedroom, 1-bath house built in 1943. It was on a 9,900 square foot lot, 700 square feet, built in 1943, cosmetic fixtures. This is what it looked like when we sold the property. Not that bad. On a flip overview, the price is $350. We're gonna have to put $65,000 into the renovation because you had to add 1 bathroom on it, and then we had a value of $499. Estimated profit on that is gonna be $10,000 to $15,000 if you use hard money and then sell it off. Cash invested would be 83%, which is a 12.5% return. Not good with leverage. We're targeting 30 to 40%. So as a flip, it didn't work that well, but as a BRRRR, it can work actually fairly well. Buying it for $350, the rehab $35 because we don't need to add the bathrooms to get the rents out of it. You do more of a cleanup. Then we had a value of $475 with the light renovation because we brought it down because we're not bringing up the value. And then the big benefit is you're going to get a $100,000 equity position on this deal. Not much cash flow, and we'll go over in that in a second, but the equity position is huge. So as you can see, not that bad of shape. It just needed a paint job, needed a general update. Nice big backyard though. That was the value add approach on that. And as you can see, it wasn't terrible. It just wasn't great. And so need carpet, paint, flooring, maybe a kitchen update, and then you'll get it into the right condition. So then this is our pro forma for our rentals. We are making a very simple calculator for our clients to where they can just plug in numbers that will kick it out. And that will be out at the end of next week. But this takes the purchase price of $350, the rehab, and then the new appraised value. We factor in 2 months to refinance it, 2 months to rehab the property. So that's 4 months we don't think our client's going to get rent income on this, to be conservative. It wasn't a big rental. It should have been rented in like 30 days. But then you got to get an appraisal, refi, all those things. The reason this is important is because we need to account for your debt cost and whether you have to leave that money in the deal or not. And so because that all gets rolled into that 75%, right? The total cost includes your dead time on your money because you have to make those payments. We had a rent comp at $2,850 that we'll look at for this property. So we have a rents in here. Then we break down taxes, hazard insurance, mortgage payment. With that single family house, we don't put in many expenses because most time when you're leasing it, especially around here, tenants are paying utilities, maintenance, everything. If it's an apartment building, we're usually running about 30% expenses because they're not used to water, sewer, garbage isn't included. And typically we're putting bill backs in there. So the expenses will all be broken down this way. You're allowed to change anything you want on this, right? You might be like, well, I'm doing a property manager and they're 12% or whatever it is. And then you add it in and you get the cash flow. So on this property, they paid $350. They rented it, new value $475, $2,850 in the rents. That's going to cash flow this person $199 a month. That's not a ton. But the kicker on this deal is the $100,000 in equity because you can take that deal, 1031 it later and trade it out for like 2 to 4 units. And you're still covering your cost at this point. This breaks down all your acquisition fees when you buy the deal, your construction loan, all your holding time rehab. Then it's going to break out how we came into this. So we base this cash flow on a 7% rate here. That's actually fairly high. Right now, we're able to get in the low 6s with commercial loans. And so if someone was able to refinance this at 6.25, it actually just increases the cash flow dramatically. And so based on these numbers, the client was going to have to leave $53,000 in the deal. And they were only going to make a 4% return on their investment. But what we're looking at and how we're looking at deals is every market gives you a different investment opportunity. Last 2 years, it was like you had to chase that big fixer. You were going to get big upside. You had cheap money, so you cash flow well. But you still had to do these massive renovations. Now you can buy a deal that's more cleaner, and all you got to do is hang in there for the cash flow. So estimated rents was at $2,850. Cash invested at a 70% LTV, not 75%, was $53,000. Cash flow was $199 a month, which was a 7.8 cap, which we don't really use in single family houses, but we put it in. That's a 4% return. And an equity position of 75-100. Oh, you know what? I got ahead of myself. We'll talk about why this is a really good buy in a second. So once you go through that, you're like, hey, I like this equity position. I like the cash flow. Then we're going to break down how do we come up with these rents. We use 2 things. We use Rentometer, and then we use Northwest MLS comps. The great thing about this property is we had a rent comp for $2,950 by a broker inside of our office on one of their portfolios. So we felt really good about our rent comp. This was a little bit better house because it had a half bath, but it was also in a way shittier street. It was like in a whole pretty crummy zone in this section. We were in a good zone of it. And then we also had another rent comp at $2,400 that wasn't fixed up at all. It was in worse shape than what we were buying right then. So, and this is how we're kind of looking at deals right now. So we have $199 a month in cash flow, 7% return, or with a 7% interest. That equates out to a 4% cash on cash return. Once we refinance this property, as rates fall, they're predicting that rates are going to start falling in Q4 of this year, where we're going to be in the high 5s at the end of Q4. We think on 2 years is how we're looking at everything, that rates will be in 5.5, 5, or maybe even a little bit lower. But look at what the metrics does behind this deal. You go from $199 a month to $650 a month if it goes to 5.5% rate. That's a 12 to 13%. Oh, that's a 12% cash on cash return. That's a great buy. Plus, you got that $100,000 kicker in equity. If it's at 5%, it goes to a 14% cash on cash. And if it's at 4.75, it goes to a 15% cash on cash. And so if you buy these deals and you can break them even and get that big equity position, leave very little cash in, as long as you can keep them stabilized, once rates fall, your return goes through the roof. How many rental properties were you able to get 12 to 14% cash in a $100,000 equity position? You couldn't find them the last 2 years. Now you just have to kind of look at them like, what is this going to look like in 2 years? Because remember, this is buy and hold. You're keeping up. And not only that, this property, you can potentially build a dadu in the backyard. So it's got extra little kicker in it. So, and that's why the client bought it as a rental property. It's not for the cash flow. It was on a long-term investment. Now, if this is losing money every month, don't buy that. You don't want to get the asset that's going to suck all your cash back out. Do you guys have any questions on how we look at the rentals? You can get some rentals.
I have some rentals. They're just not in Washington.
Are you getting 13% in 100K equity?
I'm doing a $160,000 remodel from 4,000 miles away.
That sounds miserable.
It's
Well, don't worry, we'll get you a deal.
Oklahoma.
Other deals that we've done recently, these are, you guys, and we want to put a range of deals in here. This was a deal we got in Seattle Fourplex. It was $800,000. It's a 10% cash on cash return the day they closed. A Burien Fourplex, the client actually bought 2 of these next to each other on a 1031 exchange. It was $1.96 million for the 8 units, separate parcels, so she can sell them later. Cash on cash return was 12%, but she left $500,000 in that, right? So she's making $50,000 a year on the 500. And then we have a cheap Bothell duplex that was $462. They left $73,000 in the deal, but they're making 16% return on an east side rental property. It needed a fairly, I would say about 40, 50 grand per unit. It was pretty nasty. And those are very, very similar numbers than we're going to pitch. So average savings gives you a 0.5 point. Average 1 year CDs 0.58. That might have gone up recently. Cash on cash returns 13 to 18 is what we target. With leverage, it equates to 30 to 55% typically. So these are kind of how we look at deals. Those are the numbers that we're targeting. So next steps, guys, in the interest fund is going to talk about hard money real quick. Then we'll all hang out. We'll answer as many questions as you guys have. You can talk about whatever, and then we'll hang out and answer questions. So next steps, we're going to send you guys a survey. If you want to move forward and keep talking with us, you got to fill out that survey because we don't want to spam you. If you don't fill out that survey, we won't contact you again. Then the concierge who's going to give you a call, we're going to get you scheduled for a one-on-one with our investment team, get you pre-qualified, and then start looking for investments. other more information on free education, guys, you can go to our Heaton Dainard website. There's a lot of good stuff on there. There's stuff about construction, a 4-part series about how I run my job sites, underwriting, or you can go to our YouTube channel at Project RE. We're doing tons of free education on there, and it really is free. And you guys, this 4-part series is really good. I don't want to toot my own horn, but I spent 8 hours on this explaining what to do with detailed pictures. So download, if you have a chance, watch it. Took a long time to make. All right, so we are going to pass it over to Intrust Funding. They're going to talk about levers, and then we will wrap it up.
This one forward. All right. I will also kind of break this down really, really quickly for you. Have you guys used Harmony before?
Yes.
Locally or?
Yeah, I used Sierra's Veristone.
Okay, you use Veristone. Have you used Harmony before?
Rain City.
Okay, so you've all used local people. Okay. I don't really need to go into nuts and bolts of hard money then. Okay. Sometimes I have to go over what hard money is and kind of really break it down. So I'm just going to talk a little bit about Intrust, our loans, what we do. It's a little bit different, kind of run through our loan types and then answer any questions. Sorry, I forgot we're filming. So our big things here, we're just going to switch ahead a little bit. So again, we'll go through this because there are some online people watching. But again, hard money is basically a real estate investment loan. As James talked about earlier, it's used for properties that are typically distressed. It allows you to make a quick all cash type offer, buy the properties, wrap in 100% of the rehab, all in one quick loan. Again, the opposite is going to be trying to buy something conventionally. If you are able to secure, it's going to have longer closing times. You're not going to be able to buy the rehab. It's a leverage situation. It's an interest-only loan for a short period, typically up to 12 months. Your two exits are going to be either to fix and flip, so selling the home, or refinancing out to keep the home. So some of the advantages with us, I want to start with our first is how easy it is to get pre-qualified. So we don't have an application. Most lenders have some sort of application or big underwriting on the borrower. We do everything in-house. So to get pre-qualified with us, we need 3 things from you. Who are you? So your basic contact information, your name, your mailing address, your email, and your phone number. We need to have basically a liquidity statement. That can be a bank statement. It can be a business and personal bank statement. It can be a line of credit, the combination of all of them. We're verifying the funds you're showing us are for said project you want to invest in. We don't ask you what you do for work, what your overhead looks like, debt to income, all those things that a bank might underwrite with. The third thing is we do need a copy of a credit report. What we're looking for is your name and a credit score. We're not digging through the trade line history, anything like a bank would do. So once those 3 things are on file, you are pre-approved with Intrust. If you have a property you want to go after, we can write you a pre-approval letter 7 days a week. Again, Intrust is a primary funding company for Heaton Dainard, but we do work with anybody else outside. We can only lend in Washington State. So everything's done in-house. We say about 48 hours for funding. I like to say 3 business days just to be safe. Again, if you're qualified and you've done loans with us, Andy could probably come to us. We could fund something in 24 hours. This depends on if you have the information on file or you're coming to us at the last second. No appraisal or BPO required. So we underwrite everything in-house. Typically, we ask for 15 pictures of what the property looks like. These deals that James just went through, we've already underwritten them. They're already approved for a loan. But if you're sending something from an outside source, we need to be able to look at those pictures. Once the property is underwritten, at that point, actually, I'm jumping ahead a little bit. Second thing is all of our fees are combined into the loan. So I'm not sure with your experience with Veristone and Rain City how they do it, but everybody's going to have a couple fees. Their loan fees, underwriting fees, I kind of call them junk fees. They're going to have origination points. I know James talked earlier about the difference of 10% versus 15% down in our draws. But one thing I've noticed against a lot of companies is they want their fees on top of the down payment at closing. So if we say 15% down, 20% down, whatever the number is, our fees are going to be lumped into the loan. So hypothetically, you have a $400,000 loan with us, we charge you 2 points. That's going to be $8,000. Rather than bringing the $8,000 to closing, you're just having a loan for $408,000. So we're trying to minimize that out-of-pocket cost. Rehab funds. So we can wrap 100% of the rehab into our rehab loan. Again, the first draw is available as soon as the recording numbers come in. So if you have a $100,000 loan and you want to split into 4 $25,000 increments, say today's Monday, your loan closed today. Tomorrow we could wire you $25,000 to start the project before you ever get in there. So I just kind of walk through the loan process. All this happens on the back end, realistically, with the Heaton Dainard deals. They've already gone through underwriting. Sean's responsible for 2 positions here. He is our underwriter and also portfolio manager. So he's the one basically underwriting the file in-house. Then he meets with Will. Will would be James's business partner. They look at the deal together. Will's a sole decision maker for Intrust. So he says, the loan's approved with these conditions, might be a higher down payment, or I need to see a little bit extra. Will really has the eye on it. Sometimes he'll come back with conditions just based on his experience. Again, since they're such heavy real estate investors, it might be that there's a line item on the budget that just doesn't make sense, or he knows the going costs for X, Y, and Z right now, and you have them 25% below what he pays on his project. So at the same time, we're trying to give you educational feedback. We don't want to say we know more than you. We just want to make sure that we're both comfortable in the deal at the same time. So once Will approves something, the file goes to Amanda, and she handles transactions all the way to closing. Again, if you were to submit a loan, it would start with myself, Monroe, who's behind you back there, or Carolyn, as far as that like loan officer application status. So we offer 2 loans. We have a standard loan, which is purchase only. If you look back to the pro forma from earlier, it was the far left column. It's going to be a little bit more money out of pocket. It's basically Intrust is funding the purchase, but you as the investor is paying for the rehab out of pocket. The second loan will be a rehab loan. We do 1 loan, so we don't do a first and a second. We take the purchase price plus the rehab all into 1 loan. Any questions so far?
I did have 2 questions. So you said, seeing your credit score. So do you have to pull credit each time you do a loan, or I can?
No. So I mean,
provide a credit
as
score?
long as what we look for is a name and a credit score. So honestly, most even credit cards that give you the scores, if you log in, can see that.
Okay.
We kind of have a threshold of 650. We've determined over the last 13 years of lending that 650 is kind of where people are making their payments on time.
Yeah.
That's not going to be a hard no if you have a score less than that. There can be situations that come up. You have other active projects going and all your credit cards are maxed out because you're paying for the supplies on them. So, I mean, sometimes we might have to dig in a little bit more. We might ask for a background check if it's like sub 600, but you have a lot of experience, for example, make sure there's nothing kind of funky going on out there.
Okay.
But we're just basically validating your credit in that aspect. So we can pull one. It is a hard pull. We'll give you a copy, or you can, submit one at the same time.
Okay. I did have another question about liquidity. So what type of liquidity are you looking for as far as like based on the cost of the project? How much would you be looking to see in order to qualify for that?
So typically we want to see the down payment plus majority of the term reserves.
Okay.
I guess if you were kind of look at like what you have in front of you right there as a pro forma, I mean, if you were to put in there and that was a deal you were buying and you were doing the construction loan, the one in the middle, I mean, you would also want to be comfortable if it says you need 140, I'm just making up a number, 144,000 out of pocket.
Yeah.
You'd want to be comfortable showing that.
Okay.
Does that kind of make sense? We don't have a hard number on it. Honestly, the more liquidity you can show, the more comfortable we're going to be. It's not going to change your terms at all.
Okay.
In regards to that.
Okay. Thank you.
And then one other thing, as far as like wholesale deals, we do a lot of closings for wholesale type transactions. I'm sure you guys are all familiar with assignment fees.
Mm-hmm.
So we have no cap on our assignment fee. A lot of lenders look at the percentage of the assignment fee versus the deal price, where we're looking at if we wrap that assignment fee into all the numbers, does the deal still meet our criteria? If yes, we'll fund it at closing. Since we have an off-market team here, we're used to seeing those types all day long.
Okay.
So I know that a lot of lenders got very finicky on those lately.
Yeah.
So again, this is just kind of going through what I kind of just talked about. So purchase only, rehab out of pocket. So the down payments are typically 15% minimum on the west side of the mountain, 20% on the east side of the mountain. Where the down payment comes into consideration is a couple things. One, we're going to look at your experience a little bit. The major thing is we will lend up to 70% LTARV. So that's our loan after the down payment divided by the after repair cost. If 15% meets that criteria and it's sub 70, we'll do it for 15. If you're finding a deal and the margins are a little bit slimmer, you might need to put 20% down. Now, if we're doing a buy and hold situation, BRRRR, whatever it may be, typically we might want 20%. A lot of it's going to look to be dependent on showing that you have a takeout lender. I know James talked about getting pre-approved in the beginning. We just want to make sure you don't get stuck in the deal. You know, we want to make sure, okay, you're buying this, you're doing this to it. It looks like a screaming deal, but can you actually refi out? Since we don't require all that in our quote unquote application, we don't know if you can qualify to get out of our loan. So a lot of times we want to see communication that you as an individual are pre-approved. Sometimes you can't get the property pre-approved until you've done rehab to it. We understand that, but we just want to make sure there's some communication. So a lot of times we will ask for that, especially if you're first time working with us. Loan terms, our minimum term is 5 months. We have no prepayment penalty. We put 5 months on there. I mean, I would say right now people are pushing for a lot longer terms just because the market has slowed down. I mean, it's picking up a little bit right now. But then again, on the flip side, we'll go to 12 months. We do wrap in 2 auto extensions into our loan documents. So they're written into the loan document. As long as you are current and paying, you can extend your loan twice. It's 1 point for 45 days. So if you look at it on the flip side, it is typically more beneficial to pay a higher origination fee. I'm kind of jumping around here. Basically, it's typically 2% for 5 months. A lot of times I do 6 months for people, 3% and 4%. So sometimes paying 3% to get a little bit longer, even if you might not need it, is cheaper in the long run than paying extensions. But some people want to roll the dice on that. So, I mean, I'll give my advice and kind of leave it that be. But those are built in. We've noticed over the last maybe 6-8 months, there's a lot of people calling from other lenders and they're not wanting to extend their loans. You know, it's not written into a lot of loan terms. If you actually read your loan terms with the lender, I mean, don't quote me on this, but what I've heard is it's not a guarantee by these people. It's up to the company at the time of note maturity to say, we're going to give you more time or you're going to have to call another lender to refi to finish this project. So ours is written in. So it does give you a little bit extra. Again, no prepayment penalty. And as I said, up to 70%. The rehab loan's been our most popular here. Like I said, we wrap it all into one loan. We do the first draw. I'm going to explain how the rest of the draws work in a second here. Down payments are going to be the same range, pretty much the same program all the way through. Here's just a quick little synopsis of a draw timeline. So you can customize the draws to however fits your budget. You have to have a minimum of 3 draws. Now remember, we're not giving you the last draw until the project is finished. So realistically, probably in the last 2 years, I don't think any of my clients I've recommended doing 3 draws. I don't like it. You get a large chunk of money, but you have to get so far through the process before you get draw 2, then you have to finish before you get to draw 3. So I like at least a 4 draw scenario. This shows you 5, for example. So say tomorrow we give you $20,000, you go out and spend that money. I'm going to skip ahead real quick. This is what our draw form looks like. It's on our website. We actually have an app now you can use. You basically fill out your borrower information. All of your checking account information that you want it sent to will be done at escrow, so you've already left that information with them. Draw number 1, you just have to click the draw number 1 button and submit. That's how you get the first 20, 25,000. When you come back and you want to get subsequent draws, same form. You're going to click the draw number 2, 3, 4, 5, 6, whatever it may be. In this situation, you're going to upload 15 photos. So we're looking at progress photos in lieu of a physical inspection. We've looked around, everyone does it different, but on a low ball number, I would say the average time to use a hard money lender that has an inspector involved It's probably 7 to 10 day turnaround for them to come out, look at the project, take pictures, send it back to whoever the lender servicing the loan is for them to review it and decide if they're going to pay you or not. Doesn't mean that they're even going to pay you. They might say, you didn't do enough work, hire another inspector down the road. With us, we try to keep it simple. You're uploading 15 pictures that goes to Sean. He's basically looking at, here's what the project looked like when it started it. Here's how much we give you for the first draw. Here's the progress. It can be pictures of what the property looks like right now. It can be pictures of, I've ordered these materials. They may be on site or not on site, but here's the receipts, the invoices, or I paid these contractors. So there's a couple different ways to show progress. Once those are submitted to Sean, he'll review them, disperse your next amount out. So same thing all the way through. So we've tried to simplify the process to you. There's no time frame. You can submit. I have some people that want to get like $5,000 every week. And there's some people that want larger amounts of money. So it's completely up to how you want to structure your draws. We don't charge for wire transfers because most people aren't local that want to come here and pick up a check, but you have the option for either. So any questions on the draws? So this right here is just kind of showing two different scenarios. To say it's a, I'm reading this right, $650,000 purchase price. This scenario shows 20% down. So in this scenario, if you're putting 20% down and doing a standard loan, it'd be $130,000 down. You would have to fund $160,000 out of pocket. Compared to this situation over here, we take the purchase price plus the 160. So it's an 810 loan. You're putting 162 down, but we're giving you 160 back. So it's almost close to that 100% leverage situation. It's not always going to be an even number. It depends on the purchase price and how your rehab number is. If you have a $35,000 rehab against a $425 purchase, you know, you're going to be putting more down than we're giving it back, but it's all in the retrospect. Now we have Andy's property.
I'll take that 10,000 in junk. This was like $25,000 in junk.
So this is an example. When was this, Andy? Now I think
I sold this in April. No. Yeah.
during the peak, kind of.
Yeah.
Yeah. So this was a Heaton Dainard deal. He bought it right here, so you can ask some questions about it. We had an ARV of $1 million on it. Loan amount was $721,829. I'm just going to flip to a pro forma after you see what it looks like afterwards. So this again right here, 650 purchase, 160 on the rehab. Estimated ARV was $1 million. 5 months holding. Again, it was during the peak of the market when stuff was selling really quick. Just want to kind of point out the different categories just to give you perspective. So the standard loan over here, everything's showing 20% on this, just for even numbers. This one over here, you need $318,000 for a $72,000 profit. Again, you're getting a 23% cash on cash return. Leveraging the situation more, again, you're putting 196 out to get a 32% cash on cash return. So again, your profit has gone down by about 10,000, but you're able to not split that in half, but maybe take about a quarter, a third of that amount out that you actually have. So potentially if you were sitting on, say, $400,000, you could have done a deal like this twice rather than, you know, doing it all out of pocket. It's the same thing over here. If you had $800,000, which is the cost to buy it with cash, you make a 14% return. You could do this deal 4 times over. So it's kind of a way to look at how to deploy your cash to get better returns on it. Any questions with this? I know James kind of went through it. Okay. So I tried to go really, really quick for you there. And I will have James and everyone else come back in and answer any questions.
I wish I only spent $160,000 on that
I know.
property.
Was that?
That Lucille house.
This is one example on there.
I spent $275 on that place, but made an extra $250,000 on it. So
Yeah, you went for it. I like it. You spent $275 extra on that?
I held that thing, asbestos, the foundation
Just
crumbled.
knocked it over, dude.
I could have. I could have.
Looked good though. It made money.
Made a lot of money. I made a lot of money.
Yeah. So you guys, presentation's all wrapped up.
but we can stay around and answer any question. I mean, you guys have any questions about the market? We're doing a market update tomorrow. And then that will be recorded, that will go out to everybody too. And so I'm just going over like the tri-counties, what's going on year over year, how that ended up summarizing out, and then what we're predicting for the next year as far as, because some markets are still going to decline a little bit. And so we're just kind of building that into our underwriting right now. So, do you guys have any questions at all?
I mean, not really. I did have a question on the lending. So if it's or how does it differ if it's a property that we already own outright? And as far as using that as like leverage or down payment. So say I own the property.
Collateral type of.
Yeah.
So yeah, so I mean, if it's a free and clear property, we can do it anytime. We do owe a little bit on it. We don't do any seconds, so we would have to pay off an existing balance and wrap that into the new loan. Sometimes it can make sense, sometimes it doesn't, depending on how much you owe.
Okay.
But basically in that scenario, you would have zero down. Your monthly payment would be higher because we're not applying the actual cash value, but you would have no physical cash into the down payment. So you go zero down on the loan, we put a lien against your free and clear property, and then once the property was paid off, the lien would be reconveyed essentially. So I mean, that's definitely a good way to approach it.
Okay, thank you.
Yeah, and then can they pull interest on that if it's like a low loan to value? Like let's say the down payment's $100,000, the property's worth 500. Can they pull out 150 to cover all costs for the collateral?
More than likely, if it had that type of value with it, yeah.
Okay, yeah, so it's more.
Yeah, I mean, if the value was
Is
there,
it-
you could probably apply it towards, as he's saying, to more of it.
Okay.
Yeah, like in theory, your payments could almost all be covered by the collateral too.
Yeah,
So
it's
like-
almost, you could almost prepay like a interest reserve or a prepaid interest reserve if you had enough equity in that property.
And then once you sell it, refi it, that reconveys off both properties at that point.
And you can just continue to use it again and use it again, really.
Okay. And then as far as experience, so I know a lot of lenders that I've spoken with. So actually my property that I bought out in Philly, I ended up buying it all cash because the day before closing, the lender's like, actually, no, we don't think the ARV is right. And
They
so
change their mind.
yeah, so they changed their mind, which the ARV actually ended up being exactly what I thought it was going to be, even when we sold it September of the 22, and we had multiple offers when we listed it. So I think it may have been, I'm out of state and not as experienced. So what are your, or how does that differ in like loan terms, or does it, as far as what you're able or willing to lend to based on like X amount of experience or lack thereof?
So before you actually accept the deal,
Yeah.
we can verify exactly what the loan terms will be.
Okay.
If you have that's where, we set them up for 20% down of the total project cost. We will do some loans at 15% down, depending on experience, liquidity, and a couple other things.
Okay.
And so like if Vlad shows you a property, it's going to have it set up already approved for that collateral. So like, all right, I have this much cash, I can buy this deal.
Yeah.
And then you could go to Vlad and be like, hey, I want to talk to Intrust before. And then because we don't use appraisers,
Yeah.
so either myself or Will are putting the values on every property.
Okay. Gotcha.
That's the big difference. So hard
Yeah.
money is always a private loan. So it's up to the operators. What's happened is because the banking market went so crazy and the rates were so low, you had a bunch
Yes.
of banks get into the hard money space,
Mhm.
but they still have their appraisal boxes and they need their budgets, and because they have to check boxes to be able to pledge that loan off.
Yeah.
Whereas we're funding it with cash.
Yes.
And so once it's approved with us and title's clear, it's approved.
Okay.
And so that's really the big difference. Even with the construction draws, you send in your photos. We have our underwriter, Sean, that's worked with us forever. He's going to look at them. If he thinks something weird, he's going to bring it by us, or we approve the check.
Okay.
Yeah, if we're driving out to the property, it's because we see your photos look a little weird. We're like, okay, we should probably look at this to make sure they're not, because we treat you guys more like, even the lender side, separate from the brokerage, we're trying to make sure that our goal is to have you do 10 loans in the next 3 to 4 years.
If you do one bad deal, it can wreck you, and then you're not even a client for us anymore. So a lot of times if we're seeing something weird, it's not even just to be like, hey, we're not going to give you the money. We're like, hey, let's go walk this together.
Yeah.
And look at this, because you could be having some issues that you're not seeing out here.
Okay.
And before you pay that contractor, you should have them do these 10 things. And it's because that's like I was just at a client's property. We didn't lend them money, but we were just out there because they were having issues with their contractor, and she had just given them a progress payment check for the framing because it was completed. But then when I went out there, I was like, holy crap, this is terrible. Like,
Oh my gosh.
40% of the framing had to be taken back out.
Oh.
Like, there were stud walls moving all around, and she just didn't check out. Like, we just saw something was weird. So we
Yeah.
went out there. But for her, she's like, oh no, and she's done a lot of projects too. It was like a company she knew. And then on photos, it looked fairly good. And then you got there and you're like, oh, this is not good. and so that's where it's more of like, again, like a partnership.
Okay.
But again, we don't hire third parties to eval or run the construction. It's all done in-house. And so that's how we can give those quick decisions, because we are the decision makers, not a bank that we sold the note to down the road.
Gotcha. Yeah, that's really helpful, because that's exactly what it was. It took forever for the appraisal to come back, and so it didn't come back till 2 days before closing, and then now I have all this earnest money in, and
We
have
get
to
that a
make a
lot.
quick
I mean,
decision.
people come scrambling to us and,
Yeah.
they're like, oh, I was closing with X company and all of a sudden they can't do it, or they've changed this because of appraisal, or, So I mean, a lot of people, even on the pre-approval, if you're buying your own deal, for example.
Yeah.
We looked at one time, client sent me the address and pictures. We comped it. He knew exactly what the terms would be before he even put his offer in with his agent.
okay.
And
So, I
also,
mean, we can do that anytime. It's not going to cost you any money for us to do that.
and make sure when you're doing any loan, if it's nationwide,
Yeah.
right now with the term sheets, you need to read those very carefully.
Okay.
Because like I was talking to a lender and I'm like, he's like pitching me on money. He's like, no, we're 9%. I'm like, oh, you're 9%. That's crazy, because most guys' money is at 10% minimum right now.
Yeah.
And he's like, oh, well, yeah, but if the appraisal comes in, we don't need appraisal before closing, but if it comes in any lower, the rate goes to 14%. And so it was like a way for them to lock that loan in with 20% down.
Yeah.
And then they just went to a hard money lender and pledged it to them.
Yeah.
And so on that term sheet, if you don't read that, your rate can jump 3 to 4 points just like that. And that's so you right now you really want to read your term sheets. Or there's a lot of, like, hard money's never been a floating rate. We've been 12% since 2008.
Oh, wow.
It's not gone up, it's not gone down.
Yeah.
That's just the average. That is the normal cost of hard money in Seattle. That's how it was. First house I ever bought was with 12% money.
Yeah.
But you guys are the only hard money lender that I've seen. Like, because Baristone, they're not really hard money, because they jump around and they need to pay. Rain Cities,
Couple months.
they're the same way. Magnolia through Rain City, they're all the same way. They all want appraisals. You guys are the only ones where it's like, yes, I'll close in 2 days.
Yeah, I mean, other companies portray themselves as hard money lenders, but they're brokering the loan.
2 weeks.
If they're offering the lower interest rates, they're going to have more hoops to jump through, and they're going to be selling that loan off to somebody else. It's like Andy was saying.
Yeah, they're selling to a bank, and a bank is going to look at it just like you're getting a bank loan.
We don't sell our loans off.
Yeah.
So
And that is the big. And then some of these guys actually did start off as hard money,
Yeah.
but then their goal is, like, for us, we own numerous companies, so we don't have to be the biggest hard money lender in town. We just want to have our business that we do. Whereas they're trying to expand out all their finances, so they're getting into all sorts of different types. So they went from hard money to I call it soft money.
Mhm.
It's like a mixture money, and that's where it's unfortunate. Like, we got a bunch of phone calls like 4 months ago because the values dropped.
Yeah.
And then there was a bunch of people that were trying to get their construction draws. But then the lender who said, yeah, we'll get you your construction draws based on progress, in their term sheets, it's also based on loan to value.
Oh.
And I call it the daddy lender, is going, no, we're not giving you any more money. And so they're halfway in these projects
Wow.
and they're doing the work, and they go to get their draw, and they're like, well, the value dropped. You got to come up with cash now. And that's detrimental to people, right?
Yeah,
Like, if you're doing, especially if you're doing, I remember I was talking to, he's a big flipper in Tacoma. And he's like 15 projects going. And he's like, I'm jammed on 15 projects. And that's a
Right,
big
that
deal,
is-
right? That's hundreds
yeah.
of thousands of dollars. And And so you really just have to read your terms. Like if you're doing nationwide, just know who is your lender that was going to fund that.
Lima one.
Okay, they're big,
Yeah.
but they're bank.
Yeah.
Yeah. It's try to find like us. We'll fund the deal. If we approve it, it goes through our underwriting. 48 hours, we're ready to draw docs and fund.
Okay.
I
So
mean, it's the comfortability with the area. They've done so much investing projects day in and day out still that we know this, a company like that's gonna have to base it off of like a computer software. We don't really use any, other than MLS for comping, we
A
don't
brain.
really use a brain. Yeah. It's all just old school, I guess. I guess you could say, I was at a event last week or whatever, and someone's like asking us all about the computer software we use, and we're like, we don't. And Sean everywhere is like, yeah, software could probably replace me, but it can't at the same
not
point.
the same.
There's everything software can do for this industry, but yet we don't use any of it.
well, it's like look what happened to Zillow.
Yeah.
They bought a bunch of bad houses because their software was no good. So the same with these banks. So last minute, that's when things change. It like their algorithm was all messed up.
Yeah.
So
Just because we're here, so why not? So what about for a lot of, I live in Tacoma, so a lot of the properties out there, a lot of people are doing the ADUs, like same like in Seattle.
Yep.
And so how does that work, or how does that factor into like what type of deals that you have, or lending? So like if I had a property and I'm looking to, build an ADU, would that be something that's different than just doing a regular like fix and flip loan because I'm building something? Or how, I guess I'm trying to figure out what's the best way to like take advantage of that opportunity.
So the best way, we actually talked about this in a long meeting today. So if you're buying a house, typically the benefit to that is buying like a big fixer, right? Where you're getting the equity already, because it's going to give you the lot in the back for free, essentially, on the equity position. It usually is going to take you in the city of Seattle about 5 to 7 months to get that permit, which is actually faster than normal because they expedite that process a little bit. And a lot of times it's approved plans. Tacoma, from what I know, is about the same.
Okay.
And so what we were talking about, like what I would do in that scenario is I would do one loan right away just to get the rehab going on the house. Then you're going to be basically fixed up by the time that lot's done.
Okay.
And then there's two options at that point. You can then either refinance the house in a conforming loan, rent that out, and then because you're condoing off, you can get a construction loan on the back, or you then are fully stabilized, and then once you're done, you've increased the value, then we can do a refi and advance more money based on the new loan to value too for the build cost, as long as we know you've been approved. And so, but that way you're not drawing interest and points on a big loan for a year.
Okay.
So it's,
That money we're not gonna be using for a while, so.
So it's like you set it up with so if you're buying a house for $100,000, it needs $100,000 in work, and then maybe it needs $10,000 for permits. We would do a loan based on 210
That
with
makes
the
sense.
20. On that one, it's a big construct. We might be 25% down. So you're coming with like $50,000 down. We're going to advance you 110 to get the whole house renovated, get it in rental ready shape, increase the value, and give you the money for the plans. And then you get that going. And then once that's renovated, in a perfect world, you get a new construction loan because then you can get the cheaper money here. But we are going to run the pro forma like 2-step loan. So it's like at 6 months, you're going to get a bigger loan balance, but then you're also going to be getting income at that point, which is going to offset that cost. And so it's better to take it down unless you get it set up with like a new construction lender in the very beginning.
Yeah.
But that's again, back to full appraisal. They're going to look at you. They're going to look at the experience. So it's a harder thing to do. And so I would say do a normal loan on it. We're going to know what you're doing, and then get it approved for the secondary loan. Or if you're working with us, we've sold a lot of those types of properties.
Yeah.
We're putting all the pieces together for our clients of like, here's the lender we're using here, here's the lender here. We're also working with some new construction companies to where we're trying to do like a design so that they can just handle everything for everybody.
Okay.
And we're working with a couple companies right now. So it's like we can give you a package, a referral to a couple builders. The lending will be all set up, and then you guys will just be able to walk into the deal.
Okay.
You still got to manage the whole thing, but it'll be ready to roll.
Okay.
But you guys. We were looking at this for 2 hours today
Really?
because those lots, like in Seattle, we're trading for like, if we're in Ballard,
Yeah.
our builder clients are paying about $950 to $1 million
for that lot to build out. Now we can buy them for $650. Because when the market shifts, all these builders use bank financing. Access to capital is really hard for them, and they got all this inventory sitting there, so they freeze up first, which then allow, like even lots in Bellevue that we were selling for 1.2 to 1.3 million, we are now buying for 850 to 900 because the demand just dropped right there, and that's what we need to buy on as a fix and flip to make any money on it. And so there's really good opportunities in the daddies right now because the dirt value is down like 35%. Plus, we're not looking at just to build out. We're looking at with a different pair of eyes. Like, how do you keep this? Because there's numerous ways you can do that to make it good. Like, you can sell off one, put the basis down, save all the taxes. Then you own a property with no money in that's cash flowing at that point. Maybe you keep both of them. Maybe you keep the dadu and you sell off the remodel. And so we're building out these new performance for this too. That's going to walk you guys through that whole process with 3 different options of what you can do and what the revenue events will look like. Okay. And those will be done this week too. We're doing like a big 2023 revamp.
Okay.
Because there's so many different types. When the market cools down, when the market's hot, we all look at the same stuff. Like, what can we buy at a discount? When the market cools down, there's way more opportunities out there that you can really maximize and like step up your wealth dramatically in one deal, where you can pick up $250,000 to $400,000 in equity at the end of 9 months because of what the plan that you put together. And that's a game changer for your portfolio.
Yeah.
Because
absolutely.
then let's say you make $250,000 on a house, and let's say you keep that for 3 years and then you 1031 exchange it. That's going to grow eventually to 300. That single family house that you just bought for 300 grand, you can now go trade that for like an 8-unit apartment building. And the cash flow will exponentially change at that point. And so that's what we call them portfolio builders, those massive equity gains. And if people want to put in the work, they're really going to be able to change their whole portfolio. And that's how we built our whole portfolio. We bought the crappiest houses on big lots that no one would touch, like houses on stumps, all sorts of stuff. Like we paid, I remember this deal, and we still own it to today. We can put 14 homes on this lot in Buren.
Wow.
We paid $65,000 for this property. And we sent it out to all of our clients. No one would buy this deal. And it was when rental was really cheap back then too. So we renovated, like built this whole house up, like studs, everything down. We put $70,000 into it, which today would be $150,000. And so we're into this deal for like $155,000, and not one person would touch this. And today it's probably, before the market kind of cooled down, it was worth like 1.5, 1.6 million because of the lots. And even today, if we went to sell it, we'd still be able to sell it for like $799. And so like we actually decided, we looked at trading it out, but then we're going, no, we want to wait for the next building cycle.
Yeah.
Because then it could be worth $2.5 million. But then if we take that deal that we have no money in, and we're making $1.5 million on this over a 10 to 15 year period, we're going to be able to trade that out for like a 50-unit apartment building. And then that's where you go, okay, I'm done. Like you do enough of these trades, you can live off the cash flow and you're good. And so there's a really big opportunity in these daddies right now because we've seen the major buyers that were buying it all froze up.
Yeah.
And that's when when people are frozen, that's where the opportunities are. You just got to work a little harder. You got to dig a little deeper, and that's what we're doing. So, but the ones that you will find can be like game changers in like a 2 to 3 year period. And buying out of state's great for cash flow, but you're not going to get that there typically.
No, not at all.
And that's what this market does well. It's a wealth building market. And so like, as long as we can break even on that deal or make a little bit of cash flow and there's that huge equity gain, I'm going to look at that deal. I would rather buy a low cash flow deal with a huge equity gain than a high cash flow deal, because if I'm making an extra $200 a month, that's not going to retire me early in 10 years. But buying that huge equity position will.
Yeah.
So, and that's the benefit of our local market. You can really get into deals and create value.
Yeah, no, absolutely. That's a part of the reason what brought me here today was that, I moved out of state because it was so competitive and so expensive here. And then now things have, shifted. I'm like, wait, let's see, what's in my backyard. Let's see what it can make happen, because there's so many opportunities. And I feel like, especially in Tacoma, because it's just, are already a cheaper price point than a lot of places in Washington, but still a lot of great opportunities. So
yeah, it's pulled back. It hasn't pulled back
quite like the upper echelons, but the I mean, there's a lot actually. I mean, we are buying homes again, like in the low twos, high ones.
Great, numbers we haven't seen for more than 5 years.
Yeah, and that because it was like if we were getting to buy like 250 to 280 in a normal area, we're pretty stoked. And so yeah, we were able to pick up like 25% cheaper now.
Wow.
Sometimes more on the fixer. The fixers, if you have a good construction team, that's where the money's made right now. Because everyone's just like, yeah, that market's a little risky. I don't want to deal with this. But the discounts are substantial on those right now. Like if you have a good construction team, the opportunities are there.
Okay.
So. Nothing, Andy?
No, I was just gonna hang later.
Hey. Cool. Well, hopefully we have you guys come in for the 101.
Yeah.
And so actually Liam will be reaching out to you. Max is actually going to be our new concierge. Max did not come to our cash flow class. You came to mastermind though.
Yeah.
Yeah, you guys might be working for me soon.
So everybody comes in.
I remember Garrett came into the cash flow class. I hadn't seen him in forever. He's like, check out this picture of me with no shirt on. There was like 20 people in there. He's like, look, dude. I was like, what? I was like, please leave my eye. Yeah, I've known Garrett since I was like 15. So, yeah.
On the same street.
Yeah. So, well, cool. Well, thank you guys for coming out, and then feel free to reach out. We'll reach out with you guys. Hopefully, get you in for a 1-on-1. If not, you can always fire us off questions, and we'll be happy to answer.
Yeah.
So.
Absolutely. Well, thank you for the